Hey there, everybody. Welcome back to another 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I am your host, Harper Michael LoPiano, and I am at the bottom corner of the screen today. My typical recording platform is having some stability issues. Can't get my camera to work there, so we're using a different platform right now. Hopefully, not going to be any issues there. But I get to be in front of the page, green screen to the background. So that's fun. If you like this, let me know. Maybe I'll just do this for my recordings. We'll see if you like this setup better. So today we're going to talk about what this event was, some possible explanations for what was going on yesterday, what might have occurred regarding the announcement of this Staplergate product. That's coming up today, as well as thinking about understanding the conditions under which something like that appears and how to think about that in terms of understanding trading, price action, and what the major players who go ahead and drive that, who make that happen, what they're largely aiming for there, as far as I can gather. So that's coming up today. We are going to start with our gratitude for today's video breakdown, and for today's article goes out to, I should say, Gamma Chad, as well as to our monthly supporters, Not Medical Advice, Master, Kurt, Lusko, Cosmotropic, to Swag 52, and Hey Lucky's, aka Faithless Looter. Bonus points to Gamma Chad for having the perfect name for the things that we talk about here on a regular basis. So you can always catch Gamma Chad at our weekly live streams coming up, of course, this Friday at 4 p.m. Eastern time at market close. So some excitement, right? Some movement from the company, some news from the company, a little teaser from the company. The first time I guess since the bond offering stuff. So basically, like when did the bond offering close? Like the 18th. So finally getting some movement there. Price of the stapler getting up to around the price of a Bitcoin, which is reaching some new all-time highs here, pushing 112,000. See how that's going to look over the next couple days. But of course, right, there's the question of what's going on here, what's going on with this type of event, right? So we see this pattern. Affectionately, I like to refer to it as an guys event. So, right, this is the type of volatility event. So this is right. This is what volatility looks like, right? This is what happens to the price when we see, when we see internalized volatility come back onto the tape. So you'll notice that it'll come in these very dense sort of blocks of buying that covering a few minutes. So you'll see several million volume all of a sudden shoot off in a matter of minutes, of varying degrees, right, of varying magnitudes. This looks like it was probably about 2 to 2.5 million in the span of about, I don't know, the biggest of this probably in about 3 to 6 minutes. So something like this, right? We can see this peak down here on the tape. Yeah, so this whole move here was about 2 to 2.5 million in volume. Not obvious that was what was going on until we got back to VWAP, and then as soon as we hit VWAP, cowabunga, right? So these types of events, they can kind of get folded into a broader, more volatile environment. I mean, this kind of right angle pattern in general is that, volume de-internalization. We did see a few of these in the November, December run. Obviously, we saw a couple very large sort of gasket steam valve escape stuff back in February as well. But you'll recall that we saw these kind of little guys quite a few times in the period late July to late October last year. In fact, right, I'm being able to, I mean, if you were back in the Reddit days, the peak open interest newsletter Reddit days, just before, the Roaring Kitty run in the fall, we had some fun looking for this stuff and trying to anticipate these, trying to map these out, see if we could figure out when an institution was possibly setting something like this up. So yeah, here of course is the inspiration, right? Why is this called, and why do I like to affectionately refer to this as an guys? Well, you'll see whenever we get one of these, there'll be a number of posts on Superstonk or X where, there'll be a picture of the right angle, and then someone will say like, guys, or like something's happening. Be like, uh-oh. Yeah, something like that, right? We'll just see a bunch of these posts. So I like to call these an guys, a lot of us over on the stream, of course, too know this. We love to talk about the guys. Very fun. But right, what's very interesting about these movements is they typically span very typical, what would I say? They span structured ranges. So one of the reasons why I look at gamma exposure on a regular basis is to familiarize myself with the key levels throughout the day. I've talked about this a number of times, but we have some new people coming in all the time. Always worth going over this again so that you can make sense of, well, why is he spending time on this? Like, I know TA, I've heard of TA, like open interest, okay, but why does he always talk about gamma exposure? Like, what's going on there? Right? I mean, a lot of this I learned especially from spot gamma. Some of the key terms, a lot of the key terms I use with respect to this are key terms that I learned from spot gamma. If you hadn't heard of spot gamma, definitely go check them out. Right? You'll notice I post a lot of that. That was really my inspiration for starting to look at market maker gamma exposure especially. And really, what that tells us, or what that can tell us, is what the character and let's say texture of market maker hedging will be, especially options market maker hedging, with respect to certain key price levels throughout the day. So you recall my post yesterday, right? I said exactly this, right? High confidence trading into today is pegged at 2250 to 2350. Okay, so what does that tell me? That tells me, right, that's based off of course, these gamma charts that tell me, okay, well, based on how we're kind of clustered here, based on where we have our most important concentrations of market maker gamma exposure, that is the exposure on the part of the options market maker to the rate of change of delta, or in other words, the rate of change in value of the underlying. So, right, an options contract's delta is its rate of change, the degree to which how an options contract will change in value based on a $1 move in the underlying. Gamma values are the rate of change of that change in the options contract per $1 move in the underlying. So what you'll often see, right? We'll see gamma values will very typically they will as we get into these low implied volatility environments, what will happen is, right, rather than have our gamma kind of spread out along a number of different strikes, as IV comes down, the implied move, the implied forward-looking move, which is usually what IV measures, the implied move, right, means that smaller implied move, smaller volatility means that we're going to have this narrowing effect in how our options positioning is situated. And you'll see this, right? So when we look at our gamma charts, for example, we can look at today's down here real quickly, right? We can see, well, we have actually a lot of OI up here, right? Going into this week, like we've got a lot at 30, but 30 is barely showing up as a little blip, right? We've got 32 here, barely visible, all the way up to 40. There are a fair number of contracts, I believe, up at 40. Let me take a quick look, but let's see if we take a look at our OI figures. Whoops, not what I want. Yeah, so for like this week, how many contracts we have at 40? Actually, not that many, only about 2,000. Yeah. So, well, we kind of get this squishing effect, right? So we get this OI squishing, and we get, as you can see, right, we have very high concentrations at 23.5, 24, 25, 26, and then it kind of thins out basically up to 30. Then we have a decent pile at 30, but right, 30 is barely showing up over here on our gamma chart. Right. Okay. So where we have these important concentrations, basically that can spell out where the price is likely to go and where it is not likely to go. So when we look at any given weekly expiry, we can anticipate that more than likely the price is not moving out of the confines of this particular gamma setup. So where we have concentrations of gamma is where it is likely for the price to go. So you say, okay, well, is this week like, are we going to run to 40? No, probably not, right? Probably not. I mean, number one, that's a very large move. Yes, implied volatility doesn't suggest that, but right, we have no options up there. So, right, this is also a lot of this is predicated on this idea that, right, the majority of the volume that we're seeing intraday is hedging, and it's largely hedging options positions, right? So each options contract that is extant, that is open, corresponds to 100 shares of the underlying stock. So the options market maker is constantly juggling these shares back and forth. So really, right, what we see retail is not affecting the price by going ahead and buying shares. That doesn't even reach the lit market, right? I mean, it'll get recorded, but that doesn't affect the price. That's automatically filled at the mid by an exchange, but it's not affecting the price intraday. So largely what we see affecting the price intraday is major institutions trading shares back and forth between themselves based on how other institutions are buying. And most of that is going to be dynamic hedging. We also know that a certain number, right, of a fair amount of institutional volume is also not making it to the lit market, right? Usually when we look at GameStop, especially lately, more than half of institutional volume is not reaching the lit market. It's not affecting the price. So most of what we see is this dynamic hedging of options. Okay, so when we see these concentrations of gamma like so, moving beyond these concentrations of gamma means that the buying volume is going to go away, right? Once these strikes, let's say these call strikes move into the money, well, there isn't more hedging. So what's going to happen to the price? If there's no buyers up at this point, right? No one is going to trade the price up. In which case, options buyers, options traders are going to go, well, we know that above these ranges, there's no hedging taking place to buy the price up. So time to flip back the other way and then trade it back down, right? So hedging can then sell and short shares back in the other direction, and you can make profit either by shorting calls or by buying puts or something like that, right? So, okay. So these levels will tell us what our highest likelihood of trading ranges, right? What our price levels are most likely to be seen intraday. So if we look, for example, at today's, right, we can see, okay, there's our largest position, our largest call gamma accumulation spot is at $24. Going into the end of the week, the options market maker is incentivized to see that position close out of the money and have all of those calls expire worthless, right? They're primarily juggling options back and forth and hedging. They want to be on the short part of those options. That's going to benefit their market making strategies best. Of course, they're making money off the spread, but and they're making, they're taking commission off of contracts that are traded, right? They're collecting fees, or probably, I actually don't know the degree to which they get a portion of fees that are handled by brokers. But in any case, brokers deal with the fees, so they're incentivizing volume. Anyway, so we know that this level, right? So we can look into this week, right? $24, very likely that that's going to close out of the money this particular week. But right, we can see, okay, well, there really isn't also much open interest below 2250. It gets very small, right? Or not just open interest, but gamma accumulation. There's not that much. So, okay, we can see even kind of at the remnants of today's 2250, kind of looks like it's going to be the lowest extent of our trading. We know that that's primarily sold puts. So that's going to be puts sold by traders at the bid to market makers. So the market maker is going to be long those puts, which means that as that level is approached and the gamma value of those contracts spikes, it means that market makers are buying shares at a high rate. So that's going to serve as a support point intraday. And then the reverse is true, right? So going up. So 24 is going to be that position of where, say, purchasing shares in order to account for short calls, which are trader long, is going to peak. And so this is going to be, as we approach this, right? So purchasing of shares on the part of the options market maker is going to ramp up, and then it's going to run out after this. It's going to decrease after this. So we can see by looking at this, okay, we have support to the downside, 2250. We have 23 and 25 areas do ramp up a bit. So if we start around 23 or if we start slightly below 23, right, we'll have a little bit of resistance there, but then it sort of hedging will pick up. If we get the right amount of volume, it'll pick up and then it'll peak basically going into 24 and then it kind of cools off on the other side of that. Little bit of pick me up from the 25s because their gamma values will increase as we get closer. We're still pretty far from that. But we have this kind of hedging dead zone, which means 24. We're slightly on the other side of 24. If we do see that intraday, it's going to go ahead and flip around and serve as an inflection point where then institutions, options traders are going to be incentivized to then send us back down the other way. Okay, so we could tell right from yesterday's setup, all right, 2250 to 2350, that looks like our highest predictability range, right? 24, 25, still having that kind of character above us of resistance there. But 2250 to 2350, based on our IV levels, that kind of $1 range seems like our highest range of predictability. So, well, that even stands true for, it doesn't matter how you condense or spread out that particular volume. If you dump 2.5 million shares in a span of 3 to 6 minutes, or you spread it out over I don't know, a couple hours, it's going to do the same thing. It's going to behave the same way. It's going to cover the same distance. It's just the speed at which that distance is going to be covered intraday will change. And that is going to have a different effect on the implied volatility, which means that it may slightly extend the range. So we did move up above that. It was affected by the fact that, yes, IV spiked about 9 percentage points on this run, which meant that out of the money contracts did go ahead and have their delta values appreciate, largely in the sense of long call. So that would have resulted in a little bit more hedging on the part of the options market maker as a result of that IV appreciation. Right. But so we saw this actually occur a lot of times. Like you'll recall, like I said, back in the old Reddit days, we saw a lot of this happen. We saw a lot of this take place. In fact, I kind of mapped these out. Yeah, down here, at least these 5 occasions, right? We saw this take place from late August into late October, and they were maybe $1, $2, right? Not we would consider in the grand scheme of things for GameStop, $1 or a $2 run is not particularly exciting compared to these days where say especially coming off of the May-June excitement. Doesn't seem like very much, right? But these little subtle moments can cause very, very profound appreciations in terms of our options contract. So, for example, if you knew, now, of course, how are you going to know? But if you went ahead and you purchased long calls, let's say leading up to this move, so 25s for next week, in 3 minutes, or I guess this is in a total of, yeah, just under 10. Just under 10 minutes here. This was a 250% or so move. So very large move to the upside. Now, obviously, the long side of ones is always the most difficult to time. You need to be the most precise. The trade itself is not structured in your favor, especially as a retail trader. If you're an algorithm or you're an institution where you're going to go ahead and de-internalize some volatility, then okay, you have an information advantage. You're the one that's causing the move, so you can go ahead. You're not taking the same risks when you go out and you purchase these contracts. As a retail trader, you're not the one moving the market. You're not the one pulling the trigger on this price action. So you're at an additional disadvantage that, say, an institutional trader is not with respect to that type of move. But right, as a retail trader, once you see this happen, right, once you see this kind of run the gamut, as it were, you could then go ahead and, what do the institutional traders do? Well, it runs up here, and as it's running up, as they get to the top of this, as gamma values are peaking, they start unloading their contracts. Well, as a retail trader, you could, for example, go ahead and sell this same contract short. And if you did, within the span of about an hour, that contract would have lost about 40% of its value. Right. So not necessarily incentivized, not exhorting anybody to go ahead and do this, but I'm presenting this as a way for you to see, to understand, well, okay, why do these moves happen? Why do they happen in this way? And how are institutions or institutional traders or more experienced traders, how are they thinking about this type of event in a way like what are the types of trades and what are the magnitudes of the returns that they are looking for when this type of event kicks off. So I know, right, as retail traders, like a lot of retail traders, they focus on this. Oh, if I just buy here and wait for one of these to happen, oh, then amazing things will happen and I'll be up 250%. Whereas, a lot less risk to say wait for this type of move, right? Monitor this type of move. Don't buy, don't go long, don't hold the structurally disadvantageous instrument on the front side of this, waiting for a major institution to go ahead and pull the trigger on a move like this. Wait until the institution pulls the trigger on a move like this, and then come in here and take advantage of the IV crush on the other side. Now, obviously, there are risks to this strategy too. Like this is a very basic outline of what this looks like, but pointing this out to give you some alternative ways of looking at this environment and understanding something that is very important in the GME landscape. And we see this, right? We see these types of moves, especially when we see low IV. We see, right, IV grinding down around lows. We see the price down around, well, see here, right? A lot of these events kicked off when we were down around the 500-day moving average. So that's really around where we are right now. In fact, let's get a specific value on that. I would say, yeah, so it's right around, wait, I missed it there. Yeah, it's around 2130. So we're down close to that, right? We were down close to this before here. We're very much down and close to that presently. So when we get close to that technical level, when we get close to that in terms of 52-week IV lows, which we were at yesterday, we actually set a record in the past several years about maybe since maybe early 2023 or something in terms of how low that IV was. Intraday yesterday, it got down to 60, slightly over 60% per Schwab composite IV. Very, very low. So, right, we can see these types of events. Now, they don't occur with an outstanding frequency, but in this type of period, this is a situation that pops up. That little guy's right angle move is something we see with some frequency. Now, it may only be $1, it may only be $2, but you can see how valuable that type of move can be in the options market. And even if you don't get it exactly right, even if you don't precisely time it, it can still be very rewarding in terms of your trades, depending on what your risk appetite is there. So yeah, what are looking at in terms of today? If we look at our option structure, we can see that in terms of OI changes, yeah, largely what we saw in the short term is short volatility trades. So long puts coming off the board, short calls going on the board, mostly neutral trades around at the money, right? So this is largely, these are trades that are taking advantage of that spike in IV and then turned into a position to go ahead and sell it. So to go short volatility. So this is saying that traders are saying, by and large, they expected and are expecting a little bit of a move down, continued down in volatility. Certainly within the next couple of days. And if it doesn't work out, then they're pretty confident in these price levels anyway that these contracts will end out of the money, right? They will have charm helping them out. They will get that time, delta crush in terms of time going into the end of the week. So, and if we look out into next week too, we see it's a little bit more mixed, not as clear. So we do get a little bit of long skew on the call side, close to the money there. A little bit of bid skew close to the money as well on the put side, just out of the money there, but really more neutral. So kind of difficult to tell exactly what's going on there going into July 18th. But by and large, right, not very clearly bullish. So this is not right important to keep in mind, right? As soon as we start to see some of that volume come on the tape, we see a little bit of volatility come back. It can be tempting to be like, oh no, now we're going to 25. Now we're going back to 30. This is it. We're going to move, right? Not necessarily, and some good keys as to whether that is going to happen or whether traders think that is going to happen is contained there in our OI data, especially as we can see what the sentimental positioning, what the sentimental skew is on these trades. These can tell us what traders think is necessarily going to come out of this. So it doesn't mean that won't happen. Very interestingly, Richard also pointed this out to me, right? Excuse me, not IGME, but GMEU came off of Reg Show. So the Reg Show, the regulation show threshold securities list. So it is possible that there were a fair number of internalized fails, basically going all the way back to would have been, I guess, just prior to the bond offering. So basically, yeah, at around the time of this massive increase in the shares outstanding for GMEU going all the way back to, yeah, so this would have been the anticipation of the Bitcoin announcement, right? So the Bitcoin buy announcement that we saw the shares outstanding in GMEU increase by about fourfold. So it went from, yeah, maybe even more, slightly more than that. So from 300,000 to over 1.3 million in the span of just a few days there. So that may have been, right, this announcement, the Stapler Gate kind of announcement thing, may have been used as an excuse to go ahead and de-internalize some of that volatility that had been packaged up with some juggled fails dating all the way back to the Bitcoin buy there. So very interesting to take into account. Obviously, right, not therefore, right, not looking necessarily at anything too crazy going into the end of the week, but just to put this on your radar to help us potentially recognize, right, we could see kind of this, right, this periodic kind of punctuation of an otherwise low volume and low volatility landscape going forward. Doesn't necessarily have to be that way, but it's good to keep in mind that in this type of environment, this is something that can happen, both with respect to the scale and magnitude and the timing and duration of it. So yeah, that's going to let's see. Yeah, that's going to bring us to a close today. I'm going to try to figure out how to go ahead and um, and stop this, I guess. Now, I'm not sure how. Oh no, here it is. I can do it this way. Yeah, now I have the button. So yeah, thanks very much. I'll probably go ahead and edit this. I'll edit this so I don't look foolish. But yeah, thanks very much for today's. Thanks very much, everybody, for watching and listening. Look forward to seeing you tomorrow. Good luck out there with your trades. Good luck out there with your investment. And yeah, let's go GME.